Good afternoon. Happy Friday. This is Sean LaBelle of the Decker Hewitt Group. It was, of course, a negative week here as we continue to see markets consolidate around a bit of uncertainty. So don't confuse this market weakness with COVID right now. This is not the case. What actually had the markets moving lower this week was a more than expected hawkish U.S. Fed. So Jerome Powell, which is the head of the U.S. Federal Reserve, came out saying that the U.S. tapering process might end a little bit sooner than expected. So some of you might recall that this was expected to end in June of next year. It sounds like they might be moving up that process a couple months. And this is why we saw the NASDAQ in particular sell off quite abruptly. So this is a bit of a history lesson here. Those COVID-friendly stocks, the stay-at-home stocks, were, of course, these tech-centric names. Those were not moving higher this week, right? Which is why we know that the market isn't necessarily focused on the COVID variant. It's more so focused on the hawkish U.S. Federal Reserve. So we don't necessarily mean this is going to be the end of the bull market or anything like that. And this week's Market Watch Weekly runs through it. It does, however, mean that investors should expect a little bit more tempered growth going forward. It's important to remember that these 15% annualized returns that we're getting out of the index the last 3 years isn't normal. You can go back to 1926 when the S&P 500 index was first started, and the average annualized return is really around 10%. So we expect these gains that we've seen the last few years to moderate a little bit more to probably more of a historical standard. What's also going to become more important next year is stock picking. The broader benchmarks are not just going to move up in unison. This is definitely going to be a more selective universe that investors should be aware of next year. So this is what we talk about in this week's Market Watch Weekly. And of course, is what we've been doing in our own discretionary funds. A lot more selective than what we've been buying of late. A lot more quality instead of these high growth names that have worked in the past. So we just encourage you guys to have a read. Of course, feel free to reach out to us with any other questions. Otherwise, hope everyone enjoys their weekend. And we'll talk to you again next week. Cheers.